Hi, and welcome to our weekly market update with Morton Brown Family Wealth. I'm Dennis Morton here with Cody Demmel in the same room this morning. Cody, how are you doing?
Good, how are you?
Good. We realized we had some audio difficulties about a minute into this, so we're in the same room this morning, which is kind of nice. Good to see all of you here. Thanks for joining us. So just wanted to start off this morning. This is a live session. We want to answer questions that you have, things that are top of mind for you. With information moving so fast, we want to make sure that we're attuned to the things that are meaningful for you. So the chat is live. Feel free to enter questions in the chat. We'll be happy to answer them to the best of our ability and offer you some insights from our perspective. But as always, we're gathering questions during the course of our interactions with clients during the course of the week. We want to start off by just talking about some things that we've heard recently and things that we've observed. So, Cody, one of the questions that I've had recently with kind of the litany of bad news or things that are kind of calling into question people's plans, what's positive about this market? What can you make the bull case? And I want to tie this into something you saw last week about a change in retirement plan statements, how people are going to be presented with a different set of information. What did you see about the 401k statements and what you're going to see starting, in the next quarter?
Yep. So to briefly touch on the first part, there's a lot to be bullish about in the market where we're at now. If you just look at the earnings that we see recently, they're still coming in strong. Even with the drop off we had, some of the valuations of the companies have obviously dropped off. So if you still feel good about the companies and the overall economy going forward, you can make a good argument there. And then on the fixed income side, even though the actual price of bonds have dropped this year, we're able to get a little higher of a yield than we've been able to get over the past couple of years. So those are two positive developments so far this year. And then on the 401k statement side, with one of the laws they passed in 2019, when you get your 401k statement starting maybe in the next couple months, there's going to be a new line item that shows what the average income may be when you get into retirement. So in the example from the CNBC article, they were talking about if you have $150,000 in your 401k and you get a 5% withdrawal rate, if you were to put it into an annuity, they're instead of focusing on that 150,000, they're going to focus on on your monthly income, maybe around $600 a month, which may be a bit surprising for some individuals. Instead of seeing that main line item of 150,000, they're going to try to focus more on what the actual income replacement may be for your 401k.
Yeah, and it's I found an interesting blog that circulated this week from a firm called Elm Partners, and they talked about kind of that optimistic side of what that actually shows you, because interest rates are going up, it's having an impact on the markets. But they point out that if you look at the numbers which really matter, which is how much income can I generate off of my portfolio, you might actually see a situation where the income you can generate off your principal is actually higher than it was at the beginning of this year, even though your principal might be down. So they give an example of a $5 million portfolio that might be down 10% and only worth $4.5 million, but the income that you can earn off of that $4.5 million is more than it was just a few months ago. So I think we have to look at, this comes back to the financial planning and not just looking at balances. The easy thing when you get your 401k statement or your brokerage statement is to look at that dollar figure. I'm up this much, I'm down this much. But the more complicated thing and to do is to work through, well, how much income can that generate? How does that fit in with my Social Security questions? How does that fit in with other income sources and everything else? There's a lot more at play than just am I up or am I down? And there might be actually a positive story to bear there.
Okay.
But interesting that they brought up that just the idea that it's based off an annuity value.
Yeah.
Right.
Yeah.
Because that's a little bit controversial too.
And they're talking about potentially putting two in there, whether you do it as a single life annuity or if you did a joint life annuity, assuming that you're married. So it'll be interesting to see how they come up with those numbers too. Is it just the recent annuities that have been put out? Because they're obviously changing all the time too, depending on when you bought it. And I know there's been some talk around maybe a potential increase in the annuities here recently, just with the volatility, with people getting a little skittish or thinking where can they get safety but still have a little bit of an upside compared to maybe in the past couple of years, some people weren't feeling the best about annuities that they bought 5-10 years ago.
What do you think about annuities?
I think annuities are interesting, and depending on your situation, you can make an argument for it. But at the same time, for the average person, there's probably a better way to do it that gives you a lot more flexibility. And that's one of the tough things about annuities is you're giving it up a lot of the flexibility that you have if you're just in a diversified portfolio, instead of if you're in an annuity.
Yeah, Katie and I talked last week about just guarantees and the trade-offs that you get when you seek out a guarantee. And then sometimes that's the appealing part about buying an annuity is that, okay, my principal is going to have some protection. It's going to generate lifetime income. But, when we talk about creating an income stream in retirement, one of the advantages right now is that if you have a diversified portfolio, if you have some in stocks, some in bonds, and they're in different funds, so you have a stock fund and a bond fund, just to keep it simple, when you decide to take income, you don't have to pull from the stock fund when it's down. You can pull from something that might be down a little bit less, or you can choose which bucket to draw from. But the annuity is very monolithic. It is what it is. You can't access the principal. It kind of locks you in to that channel.
Yeah, and being in say just a 60-40 allocation, with 60% being in that stock fund that Dennis was talking about, and 40% in the fixed income. Being able to take from majority of the fixed income this year when we've had a sell-off in stocks, and letting the stocks do what they're going to do over the short term, or even in the longer term. If you think about 40% of your portfolio is in fixed income, if you're only taking say 5% of that every year, there is a long way to let stocks do what they're going to do, and let them bounce back, and then you can rebalance to try to get back to that 60-40 allocation. Well, obviously not taking all of it from fixed income, so you're not getting too aggressive, but it gives you a lot more flexibility on where to pull the funds from.
Yeah, and annuities they're interest rate based products, right? So insurance companies make their money off of spreads and interest rates and everything else, and you have to be careful about just what you're giving up to get a guarantee, what you're locking in. So somebody that bought an annuity 10, 15 years ago, you might have locked in a guaranteed growth rate in the 5 to 7% range, an income rate in the 5% range. Those things they're hard to find anymore. They don't exist because interest rates have been so low for some time. So as with anything else, it's a complicated conversation, but interesting that when we talk about 401ks and what you can earn safely, that income amount is important. How you get there is a more complex conversation.
Yeah.
So again, feel free to drop your questions in the chat. Another thing that we continue to hear about, and one question that came up was, what's happening? What are the influencers for inflation? What's happening there? How long do we expect it to last? Some interesting data coming out from whether it's Target updating their information, whether it's Walmart, on what's happening in inventories, Macy's coming out. It seems as though a lot of retailers are stuck with the wrong stuff.
Yeah.
Right?
Yeah.
Talk a little bit about that.
Yeah, so it was interesting. Some of the major retailers this week and last week came out, just that they have a lot of inventory that they're not exactly, that they don't want at this point, whether it was from supply chain issues and they got winter clothes or clothes way months late. So they're trying to get rid of those clothes now at a discounted rate. So their profits may be a little lower. But what that's showing is maybe people are spending, or potentially people are just spending less at retail because we're seeing higher inflation in different areas, like gas, unfortunately, continues to go up the way it is. But it is, if you think about the positive signs about that, it is good to see some of the retailers potentially showing that inflation may be slowing down. And a lot of the economists have been talking about that. Of course, you're going to see some economists that say inflation's peaked. You're going to see some that say inflation continue to go higher. But it is interesting to see that in certain areas it may be slowing down. And I think we've seen the same in new and used cars. Those numbers have came down a little bit too, which was good, because that and gas have made up majority of the inflation numbers over the past year.
Even there's a CNBC headline this morning that mortgage demand is falling to the lowest level in 22 years. And I think what this highlights is, a lot of times we sit here in our living rooms and we watch the world around us and we say, oh my gosh, things are changing so fast. But what's actually changing so fast is ourselves, our behaviors, the things that we wanted, the houses that we wanted a year ago, we don't want as much now. The clothing, the materials, the supplies, the services that we wanted, it's all changing like this so quickly, and our behaviors are showing up in the economy. And that's what it is. An economy is a collective set of decisions that we're all making that just kind of nudge one way or another. And sometimes it's moving in really slow pace. In the last 2 years, last week we showed you the chart. It's spike up, spike down. And there was a quote, I think one Citi analyst in an article about the inventories. The quote was, he says, there's been a lot of misforecasting. Yeah, thanks. Yeah, if there's a phrase for 2022, it's that there's been a lot of misforecasting. Janet Yellen came out last week saying, we got inflation wrong. Their companies are coming out saying we got inventories wrong. We got demand wrong. And I think that's where we've talked a lot about this as investors. You have to give yourself grace because you can't forecast. Yep. There's just no way to get at it, right?
Yeah. I mean, it's especially tough if you're trying to time the market. Like unfortunately, a good amount of people try to do, whether it's the bottom, and you'll see analysts say that the bottom was in May. You'll see some others say it wasn't the bottom yet. But trying to time that and just trying to time even certain sectors inside the market is always going to be tough. And then you just see, obviously, the different economists changing everything depending on what's going on just here in the shorter term. That's just not something that we want to get into on trying to time things in the short term, because things are going to continue to move. And maybe they have a lot more inventory here now because they're so scared of what happened back in 2020 when everything kind of shuts down and they didn't have anything to be able to sell when people still wanted to purchase things. And I think it is good to see too, is normally inflation comes from the service side and not as much from the good side, where here recently over the past year, it's been a lot of the good side, whether it's used cars, gas, everything else, where now you're hearing some of the hotel CEOs come out that they think it's going to be their best year ever. So it's good to see some of those services pick back up.
Right. And that's going to show up in, again, who knows how, and you can't project that forward, right? Yeah. Even though we don't know what it's going to be between now and next year. What else are some other things? I think one of the things that we had questions about recently, the S&P 500 gets a lot of headlines. Let's talk a little bit about what about small cap investing? Like tell me the difference. If I've been concentrated in the FANG stocks or large tech for the last couple of years, there's a whole world out there of small stocks. Why should someone invest in a small stock versus large?
Yeah, well, I think for a couple of different reasons. Obviously, large cap, especially on the tech side, has done very well over the past 10 years. On the small cap side, there's small cap value and then small cap growth, obviously. But overall, on the small cap side, that's actually held up a little better so far this year, especially on the value side. And normally coming out of whether we do officially go into recession or it was just a steeper drop in the stock market, normally small caps bounce back faster. And if you look at getting a little more technical, if you look at the valuations of the large cap compared to the small cap actually have a little lower valuation. So you may not be paying as much for the upside on the small cap compared to some of the large cap stocks, especially on the tech side.
Yeah, you've heard us say before that diversification means always having to say, I'm sorry, because there's something in your portfolio that's kind of lagging behind. And I think that the data point now is, even now with a lot of technology stocks selling off, I mean, Apple's still down close to 20%. You've got, a lot of other big names that have driven the market for a lot of years, not doing as well. But tech still makes up 27% of the S&P 500. That's a massive chunk. A quarter of the S&P 500 is just in one sector. And those things change over time. If you go back, 15 years or so, you had, energy stocks making up, 6, 7, 8% of the market. They make up 2 now. So you get just inside of an index, you get these expansions and contractions happening. But that's why it's important to, when we're building a portfolio, you're kind of setting things up to be not just capturing all of one moment, but a lot of different moments that can occur. Yep. There's another article that I thought was kind of interesting. And feel free to drop some questions in the comments here. I'm happy to answer anything that you have in real time. But one other article that we found I thought was kind of interesting was how important the construction of your portfolio is at the beginning. So when you're thinking about how to manage something, if you choose, for example, to invest all of your money in an allocation fund, whether it be a target date fund or something that's just one fund that invests in stocks and bonds and everything else, project that out 10 years, you're boxing yourself in. It creates a lot of potential capital gains challenges. It's really hard to generate income. It's hard to manage the liabilities if you're just going with one easy set and forget it investment and then pushing it out there 10, 20 years.
Yep.
At the beginning stages, Cody, if you're putting together a portfolio, what are some attributes, if you could start from square one, how would you build something so that it gives you the most value later on?
Yeah, especially inside of a brokerage account. So outside of a 401k or an IRA where you have to worry about capital gain distributions, like Dennis was saying, if just for a target date fund, for example, if you had that in a brokerage account, you may not ever sell that mutual fund, for an example, but they may be making buys and sells. Well, they definitely are making buys and sells inside of that fund as the year goes on. And they may have a capital gain distribution that you get later that year, even though you didn't sell anything inside of that mutual fund. So that may be an unexpected consequence of having one of those funds. But if you were to start at the beginning and you're able to, say, have 10 different funds diversified, just for an example, in a 60-40 allocation, and as time goes on, be able to rebalance when we do have a larger sell-off like this year, being able to rebalance out of one of the ETFs, never missing any time in the market and go into a very similar ETF and be able to capture that capital loss for when you have some capital gains down the line, whether it's this year, 2 years down the line, to be able to offset those gains. Being able to have that flexibility in a portfolio is very helpful and something that we try to do for our clients.
Yeah, and it comes down, you might be familiar with the term asset allocation. It's kind of what we have in stocks, what we have in bonds, but this is an asset location. What's the right thing to own in this account versus that account? It might not be the same, because comes back to, do I own tax-free municipal bonds over here, taxable, treasury and corporate bonds over there? What's the right dynamic there? But I think the director of manager research at Morningstar said that, what was the comment? 90% of what you can do to be proactive in the future is done at the portfolio building stage. So that's where, sometimes people say, how would you invest today? What's the thing you would do? Or that to pick on news media, asking a portfolio manager, how are you positioned for this week? Well, you don't position for this week. You really have to put in a lot of work up front to say, how do we want to think about the construction of this? And then you manage it over time. But that thought process up front is really important. All right, so a question in the chat. Perspective on gas prices. Gas prices got much more expensive. What does that do to electric vehicles? Will it just level off, or we continue to see the climbs? The thing that's really hard about gas prices is just how meteoric they can be. I mean, if we flash back, this is going back to the great financial crisis when we had $100 a barrel oil, we had gas prices going up. I think people were at that point were saying we're coming out of a recession. There's going to be increased demand. It never materialized. The supply demand dynamics are so meteoric. We had a massive inflow of supply from the natural gas boom in the United States, and it just created a different supply dynamic. Now it's the demand dynamic that's really changed and kicking in. I don't think we can make a lot of projections here, but I do know that the momentum behind electric vehicles and the economic case is only becoming more evident. I just anecdotally, you see what's happening with the Ford F-150 Lightning. When you talk about, I know we would talk to people about electric vehicles, and they would say, well, it's a distance constraint, it's a towing capacity constraint, all the things that a battery couldn't do. Well, that's evolving, and that's changing as quickly maybe as gas prices are. So what do you think, Cody? What do you think?
I think it's tough too. And I was actually just reading an article this morning of an update from Goldman Sachs on what they thought about oil. Earlier this year, they thought the high was going to be around $80. Obviously, we're well past that. Then they pushed it to 120. Now they pushed it to 150. But just as easily, they could bump that back if we get more supply, if hopefully eventually everything straightens out in Western Europe and we get more things there. And then obviously just depending on what the OPEC does going forward, if they want to increase the supply of oil. So there's a lot of things that unfortunately is hard to predict, and especially on the gas side of things.
So are you saying there was a lot of misforecasting?
Yeah.
I think that's going to be the title of this episode, a lot of misforecasting. And I think that's one characteristic of any market cycle, is that we're going to overdo it. in one direction or another. In the early 2000s, we overbuilt houses. We built things on spec, and that we saw the contraction that happened in the Great Financial Crisis and how that creeped into the financial system. Right now, I think one of the things that's going to be interesting to figure out is how quickly do we rectify the overdoing it? So, to the extent inventories are building up of the wrong stuff at Walmart and Target, how quickly does that dissipate? Because they talk about, are these large retailers turning into TJ Maxx? They're going to take all the stuff that they thought they were going to need for last season, stockpile it and roll it out next season, and it turns into a TJ Maxx model. So that's the challenge for any company right now, is how do you navigate the fact that we probably, overdid it on, demand to supply last quarter, fix it next quarter and move there. It's going to be very tricky and interesting. But as an investor, again, that's why you have to expect that certain sectors are going to outperform. You're going to get energy outperforming for the first time in a long time. Maybe that comes back down to earth and we get, something like retail or technology coming back into the sunlight.
I think that is a good comment, like overdoing it, both on the upside and on the downside, especially on stocks. Like if you just look about how strong some of the moves were, especially in the tech stock back in 2020 and 2021, and now how strong the move has been on the downside. Some of the valuations on even some of the larger companies, like their price per earnings are lower than they were 5 years ago, and they're still growing almost just as fast. So if you think that growth is going to continue going forward, so kind of going back to something that we said in the beginning, some of the bull cases now is with the market sell-off and earnings still being pretty strong, you can make the bull case that if you like the valuations and the stocks going forward, especially if you have a longer time frame, where who knows what's going to happen over the shorter time frame, but you could be getting a better discount than just last year or even just earlier this year.
And I think, coming back to this question about gas prices and how all this ebbs and flow and the overdoing it, I would go back when Janet Yellen was the chairman of the Federal Reserve. She had a term that she used when they couldn't get inflation above 2%. She referred to it as an enigma. The Fed's policy was we want to target 2% inflation, which seems quaint at this point, right? But they couldn't get it there. They kept pushing, and it was hovering around 1.5, never quite getting to that 2 that they wanted. She referred to it as an enigma, and the Fed was effectively pushing on a string. They wanted, with all the Fed's power, they wanted to get inflation up, and they couldn't do it. They're pushing on a string. I think that's an important thing to remember when it comes to policymakers, is that as much as they might want to do something, oftentimes they're pushing on a string. Whereas the companies that you own in a stock index, or just if you're buying individual stocks, you're relying on management to navigate, not to influence the environment, but to navigate whatever that environment is. Like if you're the CEO of JP Morgan, and Jamie Dimon's been pretty vocal recently about what he thinks the economy looks like. CEO of Walmart, JP Morgan, Best Buy, whatever it might be, you can't dictate what the inflation environment is going to be. You can't dictate what the interest rate environment, but you have to navigate it and make sure that you're still able to make money, provide services, build your customer base, all those things. And that's why I think there's always optimism for stock owners, is that they'll figure it out. They're going to figure it out. It might take time. The circumstances might change, but I wouldn't wait with bated breath for policymakers to get there, because oftentimes they're pushing on that string. So we have a couple minutes left. Just if there are any other questions, feel free to pop them in the chat. Cody, anything else that you're just seeing in the market that you think is just jumping out at you, or particular, maybe a case for optimism here?
Well, one item that's coming up on Friday that will be pretty important is the new inflation number. So that could make a good case for even more optimism if that's lower than some of the numbers we've seen over the past couple months. But again, I mean, if you feel good maybe you don't feel good in the shorter term about where the economy is, but going forward, you can make the argument that now is a good time to get invested if you're seeking have some cash to put to work. And then obviously when we still have this volatility, being able to be flexible on where you pull the income from, if you are using your portfolio for income at this point, just having that flexibility to take it from different areas, whether it's from different stock sectors that have actually done well this year, or the fixed income sector that's held up a little better than stocks, having that flexibility instead of just you don't really know where if you have a mutual fund or a target date fund, you don't really know where they're selling it from to when you take a distribution from those accounts.
Yeah. And just mentioned kind of the CEOs and people who are kind of tasked with navigating this environment. I just want to put one caveat out there as you're watching business news and everything else. When you're hearing, whether it's Jamie Dimon issuing a warning, what do you call it, a hurricane that's potentially coming, an economic hurricane, you have to remember that corporations, they have that short-term focus, and that's in many ways a good thing. They have to be responsive and reactive, but they are looking out from quarter to quarter. They're managing their investor expectations to say, this quarter, we're going to report, and we might have to make adjustments. We might have to, manage your expectations down based on what we're having. But you're not managing your money quarter to quarter. Like, we're tasking them to make good decisions, to make sure that whatever they're doing this quarter is teeing up the next successful quarter. But if you hear, Jamie Dimon talking, what you need to remember is he's talking about very short-term stuff. You need to maintain the focus on the long term and allow, the companies and the funds to do their work in the short term. So just a little bit of perspective to take with a grain of salt. Make sure the people that you're listening to and paying attention to, if they're thinking about the short term versus the long term. So, all right, it's been a good session this morning. Thank you for joining us. We really appreciate it. If there are questions that you'd like for us to answer in an upcoming session or things that are top of mind for you, feel free to reach out, and we look forward to catching up with you again next week.